Okay, let's go. A very welcome to you at our second Media.Lounge. Especially, of course, a very warm welcome to you, Professor James Owers. Before I start, I want to address to you some thoughts on the Media.Lounge, on this new format of discussion events we have introduced here. Of course, I want to address what we would like to achieve with this new format. I want to put it simply. We want to say thanks to you. In our efforts to connect the media industry with our educational efforts here at the University of Applied Studies, of course, we normally ask you to give something, to contribute, to give your practical experience and knowledge as a guest lecturer, to contribute at the stage, for example, within a panel discussion like Rüdiger did recently, or to be a jury member by evaluating and commenting students' media projects, like several of you already did in my lectures. That's the way you give something to us, and that's the way we try to say thank to you, giving something back to you. And the something is knowledge of an international keynote speaker we have here within our education. And by the way, it also has a very positive side effect, this saying thanks to you. Of course, there are ulterior motives also behind that. By giving you an international guest lecturer like Professor Owers, we show to you what efforts we do for our students to have a good education. And you should remember that when you are hiring media management students. Okay, now to Professor Owers, our today's international keynote speaker. International might not be the proper term. I think a global keynote speaker is much more appropriate to him. He was born and raised in New Zealand.
Yes.
He studied and worked in England, and he finally settled in the US. And I also would call him a global keynote speaker because he gave lectures and did consulting projects on nearly every continent of the world. I guess only Africa is missing in your records. Okay,
yes.
So you should try to say to get some lectures or consulting jobs in Africa. Then you're fully global. Okay. Professor Owers is co-editor of Media Economics, Theory and Practice. It's the most frequently used textbook for media students in that field. In his impressive career, he also did some useful things. I'm kidding. He wrote the book, The 10 Dimensions of Life, An Economist's Guide to Better Living. So could also be a very interesting keynote for today. But today's topic is he will address to us the way technology is changing the media industry in the biggest media market and how this could also affect European media market.
Well, thank you, Ewald. I appreciate the kind comments. I look forward to this being a very productive session, and I know that we'll have a lot of back and forth in terms of discussion. And so what I'm going to focus on is the major recent trend in media. There have been many major trends in media that you know well from your day-by-day experience. The increasingly fragmented audiences, declining advertising revenues for some of the traditional outlets, some antiquated production and distribution systems, ongoing demand for producing financial results, the emergence of digital technology, and the rise of social media firms. These have been major developments in the industry. How have media firms reacted to changes in the industry's environment, the operating and technological environment? Well, there have been, as you know well, many adaptations. They've changed how they operate, attempted to adapt to new technologies, made investments in new technology firms, have acquired other media firms, some have been acquired, and they have restructured. And the restructuring of corporations is my research and advising and consulting focus and experience. And so that's what I've chosen for us to look at tonight, to look at some examples of restructuring in the media industries and to see how these have been motivated by changes in both the operating environment and the financial environment of the media firms. And so a very prominent example here is Viacom Spinoff of CBS. The Columbia Broadcasting System is the second largest broadcaster in the world up behind the BBC, and it has a long history in the United States, starting with William Paley back in the 1920s when he acquired 16 radio stations that were known at the time as the United Independent Broadcasters Incorporated. He acquired those in 1928 and renamed them Columbia Broadcasting System. Under his leadership, CBS became one of the largest radio station operators and was a pioneer in television. It first demonstrated color television in 1950 from the Tiffany and Company building in New York City, and sometimes it's referred to as the Tiffany Network. Somehow I... Okay, that's good.
Would you like to take the presenter?
I'll just use
Okay.
this. Okay, so to avoid any further challenges of technology, I'll just work with the clicker here. And so it became known as the Tiffany Network. And in an interesting example of restructuring, it was renamed the CBS Incorporated, the abbreviated title, in 1974. And Westinghouse Electric Corporation acquired CBS in 1995 and took on its name. Now you may say, why would a very diversified conglomerate such as Westinghouse take on the name of one specialized company that it acquired? Well, Westinghouse had been one of the classic conglomerates in the United States, but as we've seen following its emergence in the 1960s, there were major questions raised about the efficiency of the conglomerate format starting in about the 1980s. And so Westinghouse had by this time divested many of its units, and so it felt comfortable that it had so divested its operating units that it would take on the name of the CBS company that it had acquired in 1995. And so Westinghouse transformed itself into a media firm and assumed the name of CBS. Now, in 2000, Viacom acquired CBS. Viacom started as a spin-off from CBS in 1971. So we can see the complexities of these restructuring strategies whereby we have what is essentially the child, the spin-off of Viacom acquiring the former parent, CBS. And so restructuring, as we know, can get quite complex. So what happened to CBS under Viacom? It was acquired in 2000 and spun off in 2000. And it was acquired in 2000 and spun off in the year 2005. Why was it separated out? Because after the acquisition, Viacom's financial performance was considered to be substandard. So the combined firm was not producing the financial results that the stockholders were looking for. As we know, when one firm acquires another, it pays a premium to do that. And often for the acquirer firm, what we find is they have paid such a high price that it's difficult to create shareholder value coming into it with such a high base level of investment. And so there was a disappointment with the results, and it's an interesting example of how there can be a discount placed on conglomerating firms. So after the acquisition, the stock markets became a little bit disappointed with Viacom's performance, and they were looking to improve those financial results. Now, Viacom, of course, is dominated by Sumner Redstone, who is the chairman and major stockholder, a very wealthy, very successful media entrepreneur. And so he was the key decision maker both at the acquisition of CBS and the decision to divest it in 2005. So why would they divest the operation? Well, they were quite different, the CBS broadcasting operations, from Viacom's other operations such as MTV, and the anticipated synergy was never realized. And so in looking at the optimal path, as so many firms have found in recent times, the suggested strategy for creating additional shareholder value was to divest the parts fitting together well, and they did that with CBS. The announcement was made in March 2005 with the effective date later in the year. Now we have to consider why firms divest. Well, top managers' primary goal is to return the appropriate level of recompense to the stockholders. While we can debate it at great length, particularly in the US market and maybe increasingly here in Europe, as some of the players are establishing a base in Europe for operations, some of the private equity firms and so on, that it may become a more dominant factor in the operation of media firms in Europe. But for a long period in the United States, the dominant constituent has been the stockholders. So the stockholders say, what have you done for me recently? And Viacom said, well, we have tried to realize value by undoing the acquisition we made 5 years ago. And so how we look at this from a precise point of view as a research topic is to consider the announcement effect of the transaction. So this methodology is referred to as event methodology, looking at what was the impact of the event on the firm's value. We need a controlled experiment. It compares the actual return at the announcement with the return that actually took place. It's comparing the actual return with the expected return if there was no announcement made. These are known as abnormal returns. It's called the event study methodology. Finance has established risk-return relationships, so it's able to estimate what should be the return on a particular security on a given day in the market. So if the market is up 2% and a company is of average risk, it should be up 2%. And so if an announcement comes along and the stock adjusts 8%, whereas the market adjusted only 2% on that day, you have an abnormal return of the difference, which we refer to as the 6% abnormal return as a result of the announcement. And so that's the using this well-established strategy of the security market line, a technical term in finance that we don't need to go into, and that predicts the return, what it would be given what happened in the market on that day if nothing was announced. Well, we look at the abnormal returns and see what did happen and compare what happened to the security in response to the announcement. What did we do? What did we find when we did this for Viacom's announcement of the spin-off of CBS? Well, I don't want to delve into this, but what we look at are the announcements leading up to and around the day of the announcement. So day 0 is the day the firm announces whatever it's doing by way of restructuring or making a merger acquisition initiative. And so what we find is there was no reaction from days -50 to -2. These are relative to the announcement date 0. So nothing much happened that was unusual. Very small abnormal return over those 48 days. And so nothing much happened. But when we had the announcement on day 0, things really happened. Things really happened. And so we see, looking at the week ending with the announcement, these are trading days, so there's only 5 per week, 8.24%. If we look at the period right around the announcement, the day before, the day of, and the day after, referred to as -1 to +1, that's a 3-day window, 9.37%. Very strong if we look at the statistical significance, if we look at those criteria and those commentaries on the transaction. But the thing that's maybe most impressive is what did that mean for the value of the firm to its stockholders, because that's the constituency that is being given the priority of claims here. It's very significant, and the reaction is both economically material and statistically significant, because at the time, Viacom had a market value of $4.549 billion. And if you increase that by 9.37%, they created additional $426 million of additional shareholder wealth. So the financial markets considered that the two firms separated were worth $426 million more than the firms combined. And so was that a satisfactory creation of value for the stockholders? Clearly the answer is yes. Clearly the answer is yes. And so that classically illustrates the potential value of being released when you go through a major restructuring. The consequences: by splitting the companies, Viacom was able to focus on the faster growing MTV and film studios without being, the common term that management used, without being distracted by the slower growing CBS radio and television businesses. And it has signaled an approach by Viacom to return to its core business and set CBS free to focus on what it does best. So the MTV family of businesses were led by Tom Freeston, and they had revenues of $10.6 billion. The CBS television and radio family of networks had revenues of $12.4 billion. And Sumner Redstone, the very, very wealthy media entrepreneur, would continue to control both companies. And so obviously he was very happy when his announcement generated $426 million of additional value for the shareholders overall, of whom he is one of the largest.
Excuse me, I'm sorry. 426 plus was divided between Viacom and CBS, or just Viacom?
Just Viacom. You see, all of the announcement falls to the benefit of Viacom stockholders. And so that was the increase in the value of Viacom stock in response to the announcement.
And how did CBS, what happened to CBS?
What happened to CBS? Subsequent to this, they were spun off. So if you held shares in Viacom, which increased in value by $426 million in aggregate, then once CBS was spun off, you got a special dividend that was shares in the newly independent CBS. CBS was a public company up until 2000, was private or part of Viacom at least from 2000 to 2005. Then it was created as a newly public company again with a spin-off divestiture, which takes the form of a special dividend. So if you owned shares in Viacom in 2005, you got a dividend in the mail that said, here are some shares in CBS. And so you came to hold shares in two companies. And that gave you more flexibility as a shareholder, didn't it? Because you may say, well, I like Viacom, but I don't care much about CBS. So you could then sell CBS, and you're left with what we refer to as a pure play, which would be just investing in Viacom under that scenario. So it gives greater flexibility for stockholders to choose which companies they will invest in if they don't want to hold both of the new Viacom, smaller Viacom, and the newly independent CBS. So that's where the value originally went, and it was later distributed to CBS stockholders as a special dividend. Okay, does that address that? So by separating Viacom into MTV and CBS groups of strategic business units, each firm resembles a more pure play company and will provide greater transparency. It's much easier for analysts to follow pure play firms than conglomerate firms, and value for investors. Investors prefer pure play investments. This is a very important factor and has implications for firm structure and restructuring. Investors prefer pure play firms because it allows them to hold firms in whatever concentration, whatever portfolio they choose. Whereas the managers of firms may prefer to be conglomerates, because what we find is they then have the ability for strongly performing units to offset weaker units. But basically stockholders don't have that inclination, and managers who run conglomerates that are not performing well are increasingly in the United States finding pressure from private equity firms to divest. And so there have been numerous recent transactions, or recent initiatives I should say, some of them gave rise to transactions, where the very well-funded private equity firms would buy perhaps 10% of a company and then say, right, now it's time to break up this company. So a company in the restaurant business is being pressured to separate out Some of you may have visited and seen Olive Garden and Red Lobster, which are major restaurant chains. They've been pressuring the company to separate those out, claiming that they would be worth more in the pieces than the whole. Famous investor Carl Icahn bought shares in eBay and said it's time that you separated out PayPal, the payment system. And he voted members of the board, and they are proposing, excuse me, they're proposing that eBay divest PayPal. It looks as if that transaction is not going to happen, but this is typical of what happens if managers are not sensitive to whether the firm would be worth more, broken up into different firms and creating pure plays by way of restructuring. News Corporation, an international media firm that does a lot of restructuring. Just this last week, it announced an acquisition of Harlequin Enterprises for $415 million. So it's both an investor and an acquirer. And so what we can see in a few moments is how it acquired two companies in recent times after being spun off into a new structure. So News Corporation does a lot of restructuring. Classic example, it acquired the Wall Street Journal in 2007 for $5 billion. But the same year it had divestitures that were approximately 60% of that $5 billion. So the acquisition got a lot of attention. The divestitures got much less. It does extensive and ongoing restructuring. It made that $5 billion offer, which was initially 67% above the pre-offer price for Dow Jones, the company that owns and operates the Wall Street Journal. And so there was great pressure for Dow Jones stockholders to accept the announcement, to accept the proposal. And eventually they did, and News Corporation acquired Dow Jones, and it's now one of its operating subsidiaries. So the offer was accepted in July 2000. It was widely commenting on this transaction as a commentator on the media industries. The Wall Street Journal is the largest newspaper in the USA by circulation, about 2.4 million, including 900,000 digital. And it's frequently ranked as number one in the business-to-business media Power 50. It operates as a division of News Corporation, and as we know, there are European and Asian editions of the journal as well. Now, News Corporation has been subject to a major divestiture much more recently. Rupert Murdoch announced that he considered the firm would be worth more if it was. Now, this is an interesting transaction in that obviously Rupert Murdoch is the dominant shareholder and has the major strategic say in what happens. So they announced June 28th, 2012, that the News Corporation's publishing operations would be spun off. That would become a new company referred to as the New News Corporation, and the spin-off was widely referred to as that New News Corporation. The remainder would be known as the 21st Century Fox and would be a legal successor to the old News Corporation. So the New News Corporation was spun off, took the name of the parent, and the parent changed its name to the 21st Century Fox Corporation. What was the motivation for the 2013 spin-off? Well, here a quote from Murdoch himself puts it very succinctly, that it would unlock the true value of both companies and their distinct assets, enabling investors to benefit from the separate strategic opportunities resulting from a more focused management of each division. So that sort of classically captures the logic that is often portrayed in motivating major spin-offs, particularly in the media industry, where it has been such a widely utilized strategy in recent times. Murdoch would not serve as CEO of the New News Corporation, but would remain as chairman. And as I mentioned, just last week, the News Corporation made a major acquisition. So the spin-off was approved in 2013. Shareholders approved the transaction on June 11th, and the spin-off was officially finalized June 28, 2013. And the shareholders in the former News Corporation got 1 share of the New News Corporation for every 4 they held before the transaction. So if you held 100 shares before the transaction, you got a dividend that was for 25 shares of the new News Corporation. And so you held News shares in the new News Corporation, and your remaining shareholding was in the 21st Century Fox stock. And so what we see is that that was well received in the financial markets. Without going through the abnormal return methodology again, the stock increased by 11% on the news that the company would split into two separate firms. Reflects research findings that firms increased in value when they announce that a spin-off is planned. I had the good fortune to do some of the original research into spin-off restructuring and found that on average, firms that spin off units increase in value by 7% at the announcement. So sometimes it's more, sometimes it's less, but it's almost always positive because management will only undertake a spin-off if they believe that it's going to be to the benefit of the stockholders, that it's going to have, as we'd use the technical term, positive abnormal returns. And so we found that to be the case here, and that reflects the fact that multi-divisional firms, including conglomerates, are often worth more to the investors as separate companies. And this is a major trend in the US that may be headed toward Europe because some of the players are headed in this direction and some of the companies are getting increasing attention from that perspective. Ongoing restructuring by News Corporation. Recall it was separated out in June of 2013. In September 2013, it announced that it would sell the Dow Jones Local Media Group that consisted of 33 newspapers. So just 3 months after it was created, it already entered into a significant divestiture. It sold them for $87 million to an investment firm, and they will be operated as Gatehouse Media. Going in the other direction, in December 2013, News Corporation announced that it's an acquisition of Storyful, a news agency, for $25 million, which was its first acquisition as a freestanding company in its new structure. And as I mentioned previously, just last week, it announced a $415 million acquisition of a publishing company that focuses on a very popular genre of books, romance books. So it's had a dynamic few years. It acquired the Wall Street Journal in 2007. It had the phone hacking scandal that's still playing out in the courtrooms in London currently. The major split up of the firm into the new News Corporation and the 21st Century Fox reflects a pervasive trend in major media firms. And in its first 4 months, the new News Corporation acquired, it took one divestiture and one acquisition that we just reviewed, and it reflects the ongoing search for an optimal set of divisions to comprise a value maximizing media firm. So here we've got two examples of very actively restructuring firms, and Time Warner Incorporated is another. It has proposed this year to divest Time Incorporated. So Time Warner was the overall conglomerate company. Time Incorporated is the publishing division that puts out Time Magazine, Sports Illustrated, and 19 other very popular titles. So the Wall Street Journal reported in February 2014 that Time plans to lay off 500 employees, 6% of its global staff, getting it ready for its existence as a freestanding independent corporation. The spin-off will include American Express publishing businesses, which Time Warner acquired just last year. So it acquired the American Express publishing business in 2013, and that's part of Time Incorporated, which is being divested in 2014. So acquired 1 year, spun off the next, illustrating the dynamic nature of corporate strategy and structure for these major corporate forms. Time Incorporated, the CEO of the newly to be separated Time Incorporated, said that the job cuts are necessary to right-size the company ahead of the spin-off. He stressed the need to get ahead of the changes in the magazine publishing business or face further layoffs. Reflecting the changes taking place in the industry, magazine editors will report to business managers rather than to top editors. So what we see is an increasing focus on financial results in addition and maybe to a slight replacement of editorial concerns, which of course raises major concerns for many in the media industries. Time Warner Incorporated has had a rather interesting path since it was taken over, or since it's been led, I should say, by a new CEO from 2008, Jeff Bewkes. Since then, there have been 3 major spin-offs. In March of 2009, the company spun off Time Warner Cable. So what happens on average to company values when they spin off a unit? They increase, right? That's what the observation tells us and what research confirms for us. So they increase, but now in 2014, Time Warner Cable is being acquired by Comcast Communication in a $45.2 billion deal. So that was a 17% premium over the previous price. So think what happened if you owned shares in Time Warner. It announced the spin-off of Time Warner Cable. Did that increase your shareholder value? Yes. Then a few years later, 2014, Time Warner Cable gets a takeover bid from Comcast, by some measures the largest telecommunication firm, media firm there is, with revenues of more than $65 billion. So that gave another 17% boost to the value of Time Warner Cable. So what we find when we look at the universe of firms that restructure is that one of the reasons for separating out units and creating them as freestanding firms and pure play firms is that they are quite frequently subsequently acquired. And so this is a classic, as we say, textbook example of that happening. Spinning off Time Warner Cable, 5 years later Time Warner Cable gets a takeover bid with a 17% premium for the stockholders who continue to own it. And so this is a very interesting transaction from that particular perspective. Back in 2009, AOL was spun off. Of course, the combination of Time and AOL was one of the most unsatisfactory mergers that there have been. It occurred back in the peak of the dot-com bubble in the year 2000, and subsequent after the merger of AOL and Time Warner, they had to write off $90 billion of losses in value as a result of the deflating of the internet bubble. It was a very interesting transaction, which was greatly to the detriment of the Time Warner stockholders and to the benefit of AOL, because they got to buy Time Warner with overinflated AOL stock at the time. So the 2014 spin-off of Time Incorporated, publisher of over 20 titles, had previously tried to form a joint venture with those, didn't succeed, and so went ahead with a spin-off. A company that illustrates the full cycle of restructuring is Tribune, most closely associated with the Chicago Tribune, which it published. It was founded way back in 1847, quickly got going after the Great Chicago Fire in 1871. It's a Chicago institution, as the expression is often used. The founder, Joseph Medill, and 2 of his grandsons ran the company in its early years. Started a radio station in 1924, built one of Chicago's first skyscrapers, 40-story building in 1925, and entered the TV industry in 1948. It went public in 1983. So the Tribune Company was a privately held company until 1983, when it went public with a sale of 7.7 million shares valued at $206 million. In the 1990s, it grew dramatically, spurred by loosening of federal regulations restricting TV and radio station ownership. So there was the Federal Communication Act of 1996 that greatly gave companies more flexibility to own multiple TV and radio stations, and following that, there was a major reshuffling of the ownership of radio and TV stations, as to be anticipated, given by the greater flexibility that the new legislation provided. In the year 2000, the Tribune acquired Time Mirror Company, effectively doubling its size. By early 2006, the company faced major investor pressure as the stock price had dropped by half since 2004, largely in response to the decline in the traditional sources of advertising revenue. It was a multimedia conglomerate and the second largest owner of newspapers in the USA. Investors were very unhappy with the value down by 50% of the stock in 2 years and pressed for measures to increase the stock price. Being aware of that concern, of course, management came up with some initiatives, some strategic initiatives, and this was a restructuring announced May 30th, 2006. 2 major initiatives, a stock repurchase, 75 million shares with a total value of about $2 billion. So that's one way of distributing funds to stockholders. You either pay them a cash dividend or you repurchase some stock. And the sale of 500 million of non-core assets. The goal was to increase the value of the firm and make stockholders happy. They were pretty unhappy. So it sold numerous TV stations and newspapers, far surpassing the goal of the $500 million original announcement. If we look at the abnormal returns again using the similar structure, what we find around the announcement is an abnormal return of 7.33%, statistically significant by all measures, and it represented an increase in value of the firm of $619 million. So there was a very positive reaction to this restructuring initiative as to how we can release some additional shareholder value. Very satisfactory from that perspective. So it's been actively restructuring. It had a major acquisition, Time Mirror, in 1980, and major divestitures in 2006, but it continued to disappoint investors. And an individual, Sam Zell, a very active corporate raider in the United States with a real estate backing, took the company private in a leveraged buyout. What a leveraged buyout is where the company borrows a lot of money, buys the shares from the stockholders, and the company becomes private. So Zell put up a good amount of money and borrowed a lot to take the company private in a classic leveraged buyout, which was another step in the restructuring of the Tribune Company. After the leveraged buyout in December 2007, the firm returned to private ownership. So it was no longer publicly traded, but there was a severe downturn in the economy and a major advertising slump, particularly in its newspaper businesses. There were many asset sales and yet the company had to file for bankruptcy in 2008. It eventually emerged from bankruptcy on December 31st, 2012, with a new board of directors and a new management team. And so that is an illustration of classic restructuring by some major media firms. What were the reasons for doing it? What were the outcomes of doing it? And did they accomplish the strategic goals of the management that undertook these transactions? So, Ewald, that was what we prepared to cover, and the initial public offering would take us far afield into
Yeah, it would take too long.
too long.